I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we're going to focus on one research note drawn from our most recent Assured briefing, that is the November 2024 Assured briefing. And in this note, we're going to highlight work we've done to analyze the returns, statutory insurance returns by line of insurance using a couple of techniques with capital allocation methodologies that are readily available. Not, we would argue, necessarily theoretically correct or even particularly sophisticated, but readily available, and in that sense make for a nice relatively easy and straightforward, understandable way to look at returns, both by line of insurance, which we show here, and also comparisons across companies. So if you bear with me, I'll share the screen and give you a preview of what we've done. There we go. You should be seeing it now. So there are two techniques we used. One is for the real insurance wonks out there like us. You may know that in the insurance expense exhibit, one of the columns that looks across all the lines of business shown in the IEE requires an allocation of capital to, or of surplus to line of business, an allocation of investment income on funds held, unearned premium and loss reserves mostly by line of business, and also investment income on allocated surplus. So the fact that there's investment income on allocated surplus tells you that there's a method for allocating that surplus. So you can reverse engineer that. And in this exhibit, which I'll explain more in a second, that's what we refer to in the blue there is the median return on surplus in the IEE methodology. The risk-based capital methodology, some of you will be familiar with. It's been around since the early 1990s. That's, rather than an allocation of surplus, that's actually, in air quotes here, a theoretical amount of surplus or capital needed to support the risks in a line of business. And there too, you can kind of reverse engineer what's needed to support the underwriting risks for any particular line of business. I should add that there's more description of what we've done. I'm purposely keeping this at a high level, but for anybody interested in the research, if you're a subscriber, you have access to it, and we're make available the financial calculators that we created. But if you're not a subscriber, we won't share the financial calculators, but as part of a trial, we'd be happy to share with you the research note found in the briefing, so you can understand what we've done a bit better. But let's look at the results and share 4 lines of business with you. So the personal lines, major products on the left, home farm, really driven by homeowners, and on the right, private passenger auto liability, not auto liability plus physical damage. Here we're just showing liability. And in home farm, looking on the left, you see reasonable returns in 14, 15, 16 when the combined ratio was down near 90. Relatively low years for catastrophes. But since 2017, really only 1 year that the industry, I shouldn't say the industry, these are the median results viewed across the top 10 writers of each line of business. So check that, not the industry, but at least among the top 10 writers, and to the extent that they're representative of the industry, haven't made money in the last, since 2017, only in 2019. And you see, kind of solidly negative results with a combined ratio near 110 in 2022 and 2023. So our observation is that homeowners not only continues to need more rate, but also real product design, redesign, and kind of maybe even reimagining the product to some degree. On the right hand side, it's private passenger auto liability. And there you see cyclicality. We know that at an industry-wide level, 15, 16 were difficult years, got better in 17, 18, 19. The industry had kind of returned to profitability. And then, of course, 2020 was the heart of the pandemic, and results improved notably. You may look at this and say, gee, 90, maybe 7.5 combined ratio, and only a 10% return on surplus. That doesn't sound right. Well, remember, this is liability. When you look just at private passenger auto physical damage, the return on equity, return on surplus is kind of through the roof in 2020. And then, of course, when inflation really hit hard and driving behaviors really showed a lot of deterioration in 21 and 22, results turned around and had very difficult years, money losing years in 2022 and 2023. Good news is getting better rapidly. Two other lines that we'll show here: commercial auto liability on the left, workers' comp on the right. I should mention that the scales were intentionally left or created to be the same so that they were immediately comparable. And there you see in commercial auto, to no great surprise, a high 110 or so average combined ratio, and an industry that's losing money, irrespective of float, and especially in this, many of these 10 years, were in the era of lower for longer interest rates. So there was no amount of float that was going to overcome 110 combined ratio, and you see the negative return on surplus across the major writers. And then, of course, the opposite is true for workers' compensation. Both are methodologies, all of which in these four lines are broadly similar. You see workers' compensation with an average combined ratio kind of in the mid to high 80s. These are calendar years, so with favorable reserve development, and you see returns on surplus north of 20%. So in the research note, we go through other lines of business. Again, for subscribers, we can share the financial calculator. But I thought I'd share that with you, and perhaps these are useful, we think, recognizing the kind of some of the many theoretical flaws in each. They can still be useful for comparisons to peers, useful to kind of evaluate and understand some of the different sensitivities that different variables have in influencing the overall results. And it may be useful to compare to internal models and help in this case, our subscribers think about how maybe they can sharpen some of their internal capital models. So that's what we had for you. Reach out if we can be helpful. If you're interested in a trial to our work, we'd be interested in hearing from you. Thanks so much. Have a good rest of your day.